This is a Momentum Media production.
Inside Commercial Property with Rethink Investing.
Australia's largest and most comprehensive podcast covering all things commercial investing.
G'day, how you going? Phil Tarrant, co-host Inside Commercial Property with Scott O'Neill, CEO of the Rethink Group, new brand for a business that's booming, and your personal coffers, it would appear, are also booming based on your commercial investments, according to the Australian Financial Review, back in the Young Rich list.
Yeah.
How do you feel about that?
Oh, look, it's good free marketing. That's all I can say. It's it's been a good year. Our business has really gone from strength to strength, and it's like our little niche, like commercial property is becoming mainstream, and like this podcast is a part of it. Like
Do they put a value on this podcast? Maybe they have done. Maybe it's
that's a good idea. We should have that.
Probably is. I'm sure they've probably included it somewhere. But yeah. Oh, mate, it's really impressive, and you guys should be quite proud with what you created, Rethink. And I certainly think that the proof of the pudding is in the eating. You've been able to create a business based off your knowledge and capabilities in commercial property investing, but you have a large commercial property portfolio. Is it 50-50 yet, the value of your portfolio versus the value of the business? Have they worked that out? Did they get the numbers right?
Yeah, I'll look close enough. You know, they ask for everything, and it's really like how much you want to show them. And, you know, I just show them rough numbers, and it's all verified. Like they call the accountant up. So whatever he says, they kind of basically go from there. You know, they can look up your entities and stuff like that. But yeah, there's no hiding. Like it is what it is. But yeah, look, the reason I sort of go along with it is it's just good exposure for the business. And like you said, it's proof's in the pudding. There's so many people that claim they've got that much and they've done this, and there's so much shit out there that, really there's a differentiator if you've actually done it. And a lot of the clients want you to do it because they're following you for a reason. Like if you haven't walked the talk, you're just someone selling a product. In this industry, the buyer's agent industry, you'd know better than anyone. There's a lot of people out there that just spruik the product, but they haven't done it themselves. So, you know, it's like going to a doctor that hasn't done their uni degree. It's, a bit different.
Is the portfolio big enough yet?
Yeah, I'm besides one in New Zealand, maybe an office for the business. Yeah, I'm done. And I don't know if I've said that out loud, but I've got $100 million portfolio plus. If it goes to 200, my life does not change. There's just more admin. We've already got a full-time worker looking after it, plus the wife. It's just going to have to staff up to manage the thing. And yeah, there's literally no benefit to our life.
And most property investors get to that point where they just go, you know, why? And then it's the what's that's connected with it, because administratively it becomes a lot more onerous. And if you do nothing now, and let's assume that you've bought really good assets, you probably don't need to do anything else. You know, check back in 10 years' time, you're probably going to have a very different portfolio in terms of its capital value. And that is the nature of property, and why the acquisition phase of property investment is so critical, because then you get to this consolidation phase where if you've done it the right way, you don't really do too much. So,
But, you know, the main thing is I like helping investors now, like helping myself. Like the last few properties I bought, like I didn't even blink when they settled. It's like, yep, done. Thank God. Move on. And when a client does it and they say, yeah, look, really happy with the result, like that actually means something. And building the business is the other passion. Like, you know, if we can help more people, educate them, like we're really educational based, hence this, we never try to sell anything in this podcast. Yeah, that's what
you're selling a dream, aren't you, at least, saying it? Or you're selling probably the reality of if you do the hard work and you have tenacity and the resilience around investing in commercial property. Like, it doesn't happen by accident. You actually got to work on it to actually be successful.
And it takes time. Like all my best investments are the ones I bought at least 5 years ago, you know, and the ones I bought 2 years ago will look great in 5 years' time. Like time just compounds on itself when it comes to money. And it's just skin in the game for as long as possible.
Yeah, and I went to the big reposition or rebranding of Rethink to the Rethink Group probably a month or so ago. And you said it then, and you echoed the same sentiment in the article I read yesterday, that what you're trying to do is build something which outlasts yourself and your wife, Mina, into something which is like a quasi-institutional capability of commercial property investment for all Australians. I think it's a good ambition that you have.
Yeah, look, we've got Vanessa in here from Ray White, and like Dan White reached out yesterday and just said, congrats and all that. Because I actually mentioned Ray White in the article because, you know, I want to create a 100-year business just like that business. And like, it's inspirational. Like, you know, guys like that, they're just almost custodians for the business. You know, they're not really there to collect enough cash to buy a car. Like, they're so far beyond that. And that's business to me. Hey, it's Scott O'Neill. Thanks for listening to Inside Commercial Property. I can't believe how much this property podcast has grown over the years. It would mean a lot if you could hit the follow button and never miss an episode.
was waiting for a shout out in the article around the podcast, which I think has done a lot to shaping people's attitudes towards commercial property investing.
Yeah.
And we're 54 episodes in, and it's a great thing for us to do. I do look forward to catching up. But every now and then you bring in a good guest like Vanessa back in the studio. Vanessa, how you going?
Hi there.
It's good to see you, Vanessa.
Thank you.
What's been happening over the last couple of months?
Well, what hasn't been happening? It's been a really interesting time in the commercial space. Probably the standout trend that we've seen has been around this kind of small commercial space, which you guys do operate quite a lot in. But, other than that, there's obviously, you spoke briefly on what's happening in terms of the election coming up. What's that going to mean for, capital gains tax? What we've seen with land tax up in Melbourne is probably a really interesting piece. There's a lot of talk about interest rates. We've seen inflation numbers come down. So, what hasn't been happening? It's been pretty busy. All indicators pointing towards commercial property and resi property too.
Yeah, everyone's tinkering with policies and everyone's got great ideas at the moment about what they could do to solve the housing crisis. And I'm not really comfortable with the term housing crisis or the cost of living crisis. It's just the cost of living. I don't think it's really going to change too much. It's just got to be normalised. So how you invest in property in and around that, or you run your family budget, is going to be the thing that delineates really successful people and maybe people who will struggle. But we don't want to get into that today. But we are nearing the federal election. We're seeing the coalition come out with their policy where they're going to fund directly, from what I understand, development and local councils to facilitate the supply side of things. And it's a supply side issue that we have right now. But the discussion, I'm a bit over already, this discussion around negative gearing, and it still just keeps swinging back in. We're chatting about this about a year ago, then it sort of went away. Now it's back in. And I don't know if you watch Insiders on a Sunday on the ABC, it was a big beat up around it again. And the government not giving a clear position either way, whether or not negative gearing is going to go or stay. I don't know what your read of it is.
Yeah, look, I think this is a topic that comes up every time there's an election. So it's not a new kind of talking point. So look, what it comes down to, and I'm going to be quite blunt here, is that we do have a housing crisis. We don't want to call it that, but we do. We're not building enough homes. We've still got population growth. Vacancies are really low. And it is the private sector that is funding this housing for such a big part of our population. So if they do consider scrapping negative gearing or, the discount on capital gains tax, that's going to have a devastating effect on the investor market, which is going to flow through to all those people that they're providing housing for. And all you need to do is look at Melbourne as the example. So Melbourne increased their land tax component just this year or last year. For this year, and we've seen a mass exodus of investors in the market. So I can't see, while it's all spoken about, I think that we'll talk about it a bit more, just like we have in the past, but hopefully, we just talk about it in a big circle and come back to a no change, because it will impact too many people, like that investor market, as well as they're providing housing in particular for those kind of renters out there. And a lot of those renters can't see their way to get into the housing market. So I feel like it is a lot of discussion.
It's such an emotive issue, and you see it playing out just how intrinsically connected property is with the Australian psyche, with the Prime Minister, and good on him going to buy a nice home up on the Central Coast to be close to his future wife's family and all this sort of stuff. Like, he's copped a lot of flack around that, and I think the issue is that commentators are saying that he's misread the environment, in that it's really not helped the cause of the Labor movement with him doing that. Why couldn't he have just waited 6 months until after? It's caused a lot of problems. But it just gives you a sense how emotive real estate is as part of the Australian psyche. And when it comes to investing, there is still so much misinformation around what the standard property investor looks like. And I saw some stuff just coming out yesterday based on all the numbers coming through. And the point was, they're the nurses, they're the police people. And these are just terms that get bandied around by different parts of politics. But it is an enabler for Australians to actually go about creating wealth. It's probably the most accessible enabler for them to do that. But it still always gets charged with so much emotive language around it, as in negative gearing is only benefiting the rich. And the rich are the people who are the evil property investors going out there and cultivating all the benefits of it while Australia pays for it. And that language doesn't help anyone. I think there's a lack of education around it, and that will always continue to be that way because most people don't know and or care. They just don't like the outcome of it. I don't know if you've got a read of it all, Scott.
Yeah, well, look, my opinion is it helps the middle class, get out of that. And the middle class is a very wide bandwidth now, and arguably it's not so middle class anymore. But I've seen it with thousands of investors that it allows you to invest a little bit, leverage up. 10 years later, you've got a pretty sizable equity position. And the rich will just park their money up, and just leave it there and preserve their wealth. So they're not really benefiting as much as the middle class would as a proportion of their wealth. They're protecting it, of course, but they're the ones buying the big shopping centres and stuff like that. But someone leveraging up to buy a house in Hobart, Perth, Brisbane, sitting on it for 10 years, like it's an amazing way of not being reliant on your super or your the pension rather. So yeah, to knock that out would be very damaging for Australia and turn it backwards, no doubt. But, there's many people that would disagree with that depending on what side of politics you are.
Yeah, absolutely. I think property investment is the great Australian side hustle, right? And what a great nation to go out there and advance your cause, advance your position. A lot of people get sort of caught up in trying to make money doing other things. Property is probably one of the most predictable asset classes for people, you common and guard and Aussie, myself included, to go about creating wealth in it. And what a great thing to have. So I think that the government's been cautioned not to tinker with it. I think most economists are pretty much saying there may be an immediate, very small drop in the value of properties, but the long-term impact of it is key. I saw only just during the week, you might have seen it, and I'd like your view of this as well, Scott. I think as Victorian government's come out now saying they're looking at removing stamp duty off the plan purchases. Now, this is, again, we're back to this point in time where people go, oh, I'll buy an investment, it needs to be off the plan because I don't have to pay stamp duty, whereas fast forward 10 years, a lot of those properties off the plan might still only be worth what you paid for it. This intersection between capital growth and government incentives to shape decision-making is a very dangerous space for investors.
Yeah, you only have to look at history. All those incentives that come in usually just factor into some sort of the price somewhere down the line. So while they might offer no stamp duty, you would probably find that a lot of those prices that perhaps for those off the land plan properties, might go up a little bit. And it really does wash itself out. So yeah, I'd rather them see scrap or reduce this land tax rather than providing that instead. I know that's benefiting different people, but I suppose that Melbourne's one of the places that they have been building. So maybe they're in a position where, and they've had a mass exodus of people investing. So maybe that's just that stimulus to get people back into that Melbourne market.
Yeah, a hot tip for any property investor tuning into this, if you see how it can go wrong, go down to Docklands. I don't know if you've been there recently. I was there about a month or so ago, and it was probably one of the most miserable places I've been to in a long time. It felt like a Spanish seaside town with every shop boarded up and no vibe and no energy. It's a ghost town.
I'm pretty hard on Melbourne. I think that when we had that whiskey night, everyone was kind of laughing at me a little bit because I'm pretty negative on Melbourne. But look, they don't give themselves any favours. Exactly that. Yeah. You see that, and it is quite. It's a beautiful part, beautiful buildings there, but it's quite.
City's cool. Docklands.
The city's cool. Yeah, it's pretty quiet. There's a lot of vacancies, and then I don't want to talk about student housing, but the government's come out to put caps on international student numbers, and they're focusing on particular universities, and those ones that are in Melbourne are going to be ones that are going to be impacted. So that's going to further impact markets like Docklands, where they would have had tenants in there going to the university, and maybe that pool of tenants are going to be less. So. Yeah, it's a difficult one for Melbourne.
The story of the Australian economy is the property economy, because every single decision has ramifications or implications on property. It's just so intrinsically connected with the economic fortunes of Australia. So, you can see why, as an election issue, it's going to be so key and so polarising, right? And look, I want to get beyond the discussion around negative gear. It'd be a very ambitious and brave government to actually take that to election with changes around it, because it is so polarising. The issue you have, though, it even dominates and dictates the decisions that happen through both the upper house and lower house. It's all property related because everyone's horse trading on the sides around trying to get their policies through. And I don't know who comes up with a lot of these ideas. I think a lot of them are mad. Yeah. Some of them are okay, Scott.
Well, you know what the impact, because remember the last time when Bill Shorten was bringing it in, I remember our business spiked in the commercial side. So our resi, because we've always done resi, got a lot quieter because the fear of that less cash flow or the less tax benefits really impacted on their decision to not buy. Commercial's more of a cash flow asset. They're not thinking about that negative gearing at all. A lot of them, they're there to create positive income. So relative to resi, it became more of an attractive asset class. So we actually almost doubled in demand and resi halved, like broad stats, but that's how much the impact had. So if they did bring that in, commercial's just going to get shifted to more of a priority because naturally resi will be less attractive because you need negative gearing, especially in the early days of investing. Like they say, it's on average about 7 years of negative gearing before you start breaking even because you need the rents to rise, you need to pay off debt. 7 years of no tax back would be pretty hard for most investors. So commercial naturally was one of the beneficiaries of that.
But you actually look at the other side of the balance sheet, and that is the contribution of property taxes to the Australian economy, whether it's
massive.
state or federal, right? I think less than half of all property investment properties are negatively geared, which are investments. So more are positively geared than negatively geared. That's providing upsides on the tax receipts for the government. That's a good thing. Often you don't ever hear about people speaking about the other side of the balance sheet, and that is property investors providing income to the national coffers, which are distributed out in other ways. But again, that's not really very emotive, right? It's the emotive side is people getting advantages over other people as a result of investing in property. Noted. Have you seen a change at all of people's psyche around commercial investing as a result of some of these discussions around negative gearing?
Not yet. No. It's quite early days, I think, but we almost don't want more commercial investors coming in because
there's not enough stock out there that's good already. If every single residential property investor started doing commercial, that's market's not big enough.
I want to sort of highlight that. So the stock, because look, we're short of stock, but everyone is. It's actually just the nature of the current market. Markets are always going to be one or the other. It's never going to be perfectly balanced. So, the flip side of this is everyone starts selling because prices have gone, or maybe there's a impending economic doom about to happen, time to offload your properties, and then there's stock galore. But we're in a tight stock market. It's going to remain that way. Like, one of the reasons I wanted to get Vanessa in is she's brilliant in that, sub $20 million market, because all the data out there in commercial is 5,000 square metre plus sheds, institutional stuff. The data that Vanessa has in her head is really going to highlight why the next few years it's going to be quite good for commercial particularly. And look, because of that, the market knows it and they're not selling. So there's only the odd deals out there and you've got to pick it at the right price. So it's just a market to be patient in. You have to.
Again, it's supply and demand. So you're saying that really good commercial assets are being held onto.
Why would you sell them?
Even though interest rates are high, normally they're largely still positively geared because of the nature of LVR positions and stuff. So why would you sell, particularly if there's going to be a halcyon period ahead of us? And to Vanessa's point, sort of trends in small commercial offices and sort of, the intersection with that with how Australia works, and commercial property is directly connected with Australian employment. That's where people work from, industrial, commercial, office space, whatever it is. What are you seeing? It's, I guess sub 20 million would be small commercial office. We could use that as a frame of reference.
Or non-institutional.
Non-institutional. Look, it's a really interesting topic because we do find that a lot of those people that have invested into commercial over a long period of time, they are holders of commercial property. So that adds to the no stock in the market. There's a lot of institutional, not institutional, but generational assets is probably the best way to describe it. So people that hold them, your family, and then they've passed it on. So they've been in the family for an awful long time. So unless people need to sell, and the fact that interest rates went up and we didn't see this kind of glut of stock come to the market just really highlights that unless you really needed to sell, you didn't sell. But then the flip side, we saw all the investment demand buying was in that kind of sub $20 million space. So if we look at transaction activity, if we look at volumes of sales of commercial property over the last few years, yes, it did peak in that 2001-2022 period where we saw people jumping out of residential and going, hey, let's buy something in commercial. It seemed like good value, probably likely to get better returns, that positive cash flow piece. Interest rates were really low. There was a lot of good reasons to jump into that end of the market. And we saw a really huge spike in transaction activity. But notwithstanding, that also happened in the institutional space too. So that was a very high volume. But what happened after that, as soon as those interest rates start moving up, is what's probably more telling. We saw that the institutional grade stock, so anything over, say, $20 million, really dropped off in terms of transaction activity. People were worried to be the first to show their hand, if you like, the first ones to kind of show the change in yields. And we saw volumes really jump off. So that next year we saw nearly 50% down. And then in the last 12 months, another 35.6% down it actually has been. So it's been 2 years of really quite subdued turnover levels. However, when you look at the sub $20 million space, yes, it has come back from that period, but it's been at a lesser rate, kind of about 15% per annum. So if you looked at a chart of where that went, you can see that sub $20 million space really has propped up what's been going on in the broader commercial market. And we've seen that small investors not be put off by the change in interest rates or these kind of institutional players that are just sitting doing nothing. They've looked at this and thought this is a good time to invest. And they've been a bit opportunistic. If there's opportunities to be had, like I dare say it, but if there's people out there with some distress, being able to capitalise on that. And again, they're looking at assets for a long-term hold. So maybe today they don't look like the greatest thing. Maybe they've got some vacancy in them. Maybe there's some upside, but they're looking for that long-term hold, which is what we've seen these commercial investors do. So the fact that we've held our volumes in that sub $20 million space pretty consistently compared to that big end of town is really testament to the appetite for commercial property and particularly that small end of town. Now, if you look at what asset class that's in, each year it's been more than 55% of it has been industrial. So that's a big chunk. We have had this real interest in industrial property, but also it's an accessible asset class. So you can buy an industrial from a small 100,000 square metre or $100,000 little storage unit or shed through to a $20 million asset, and for the institutional players for, hundreds of millions of dollars. So no matter what your availability of finance is and your price point, there is something there in that industrial market. Also, industrial has been the best performing asset class. Like, it's funny for me because I've been in commercial research for such a long time, but industrial was always the asset class you didn't want to touch. It was this dirty shed. Whereas now it's, that's had the rental growth. In pretty much every city we have land constraints when it comes to industrially zoned land. So while there has been perhaps some price correction or some yield change, over the long term, we've had that huge amount of rental growth. Vacancy is very low. The potential for new stock to be developed is very limited. So it looks like a really good asset class. Office, obviously, we've had some issues with office, so that's probably come down a bit in terms of demand. But retail, we were speaking before, but retail is also an asset class that's really come back in favour for a lot of these small investors.
Didn't industrial just take over office in terme of total volume this year? So first time in history, office is not the number one asset class.
Yeah, because office always has been, because all it takes is, $1 billion office sale or a couple of $500 million office sales, but those sales aren't happening. They haven't been happening for the last couple of years. We're very reluctant to sell, but we have still seen, to some extent, those kind of large portfolios of industrial transact. But it's not only just those big end of town, it's this huge volume of small stuff, which has been the mum and dad investors, not the institutional players or kind of the family offices or groups of, you've come across so many groups of like syndicates, like private people coming together to buy something a little bit more expensive that their finances will allow. But it's been that small end of the market that has really propped up that total volume number, particularly in that industrial space.
Yeah. And a lot of them would have been that, what's the resi market worth, 13 odd trillion, and commercial's about 1.5 trillion. And we've seen this firsthand. So many of the resi guys with their established portfolios are coming over, and they're the cashed up investors who they're not taking huge debts on. They might be doing a refinance, but there's just volumes of these people up there, and they can compete with any institution just because of the tens of thousands of these people out there. And because of the education and research papers like yourself, it's more accessible to target this asset class, and they are, and that's a trend that won't stop.
Maybe you can help me with this because, I'm a pretty simple guy, and I listen to this narrative and I go, well, if a lot more mum and dad, I don't like the term resi investors, have built reasonable portfolios and are transitioning to commercial, and not many people are selling good commercial assets because they don't need to, as we spoke about, there must be a real pressure on really good investment grade, small commercial investments. So the amount of competition must be fierce for it. And what I don't know, maybe you guys know the numbers, at an aggregate level, you say there's, I don't know, the value of commercial real estate is 1 trillion. How many commercial properties are there in Australia, and what percentage are office, what percentage are industrial, what percentage are retail, and what percentage would be specialty? Like, can you give me a sense, how big is, as a percentage, is industrial 30% of the market?
Yeah, you'll probably correct me, but I think industrial is around 35. Yeah. Office is about 34 because it's only just ticked over, and the rest is retail, specialty, and that type of stuff. But there's not many transactions. In the book, this is 2-year-old data now. I remember looking up the AS Bureau statistics. It was about 550,000 residential sales per year, and commercial sit in the teens, like 16, 17,000. So terribly low numbers versus resi. So, that's a storm that can pretty much just totally dominate the commercial space if they want. So imagine 50,000 residential investors come over.
But that's where it sounds like we're at right now, because if there's only that many transactions, you've got a lot more residential investors moving into commercial property. And I think you've said beforehand, most deals you look at aren't that good. Yeah. So someone's got to change for small commercial property investors to actually get good value out of it. It sounds like there might only be 100 good deals a year, right? I don't know. I'm just generalising, but I'm just looking at the basic mechanics of it.
I understand where you're coming from, but I think that what we've seen is yes, the commercial market is a much smaller market compared to the residential market. And investors who want to invest, they will find something to invest. The volume of quality assets on the market, there's no disputing it, are low. They have been for a little while. There was a small opportunity, but that closed up pretty quickly in the last couple of years. But what I've seen, and I'm not sure if you've seen it too, Scott, is the appetite for buyers to buy up the risk curve, if you like. And buying commercial is buying up the risk curve. If you're a residential investor and you know residential and you've owned a home or a unit or a portfolio of those and you're going and buying an industrial or a retail that you've never done before, you are moving up the risk curve and the yield reflects that. So we've seen a lot of these buyers that are cashed up and have an ability to finance move up the risk curve further and looking at those kind of value add type opportunities or a vacant asset that can be repositioned because there isn't those opportunities, there aren't those options available right now, and there's a greater upside potentially to be had for those sort of assets. So that's where we are in the market now. There is not a whole glut of really good industrial stuff that we can jump on and go and buy. Like they would just go. Like I'm sure you have in your mandates that you have or your clients that are coming to you, you've probably got a list very long and a very kind of small amount of properties that will even be suitable. So we are seeing investors, which can sometimes be a little bit dangerous. There's no disputing that. However, they are moving up the risk curve and their price would be reflective. But we're seeing more and more of that. Development is something that everyone's been a bit cautious of because of the cost of construction. Council's taking forever. That's not going to change. But the cost of construction piece is starting to improve a little bit. So if they have the ability to hold assets for a future use or a future development, that's what's attractive at the moment. And like these kind of things change over time. But are you seeing that at the moment? Are you seeing a bit more of your buyers happier to look at maybe not as necessarily a secondary asset, but not secondary in location, but like still a prime location asset that perhaps is a little bit more secondary in quality?
Yeah, well, look, yields are always a priority because like they're coming from residential, they want the yield to retire on. So there's a range. Like we find most of our deals are between 6 and 7%. You go over 7, the risk is reflective of that higher yield. Under that, like sometimes it's just priced too high. You know, there's a lot of people pushing tighter yielding stock because it's called premium, but sometimes it's not premium. They're just paying too much for the asset. 5% yield versus 6% to 20% difference in price. So, you know, my entire business is revolved around finding these deals. So like I've been dealing with this problem for nearly 10 years and the trick is to be patient. Like there's always deals out there. The amount of buyers out there is growing, but they're all in different price points. A lot of them give up. A lot of them, their finances change. It's like you just got to be looking and you get the job done.
There is always time in the market that people need to sell.
Yeah.
Like for whatever reason, it could be a family breakup, it could be a family emergency, it could be they just want to invest in something different, their kind of priorities change. So it's not necessarily that those assets are bad assets, it's just that everybody is in a different position in their life and they have different requirements for their money to go in different places, or usually it's got a lot to do with, particularly if they're small investors, it's a change in sort of family structure or needing to move. So there's always people that need to sell. And, you know, that doesn't mean they want to sell for a bad price, but they need to sell. So there is assets that do come to the market and it's just being patient. You're exactly right. Also, I think that we've, in a period of time, and you've probably seen this with your own business, is our availability of information is so much better than it ever has been before. Granted, all the other, I'll do the plug for myself here, but all the big kind of real estate firms, they still produce their research report over $10 million assets, which is not helpful to your end of the market. I always tell a story about a report that I did for Perth, one of the first reports I ever did, and there was a whole industrial report on the over $10 million Perth industrial market. And at that particular year, there was 2 sales. Yeah. So they wrote this big, massive report on 2 sales. And I went, okay, well, let's just do it. Let's look at transactions.
Only 2 sales over
10 million. It was quite some time ago. Yeah. And I thought, let's just see how many transactions there are sub 10. And that particular year was 842. I still remember that number because I remember, let's do a report on these 842 sales because there's 842 vendors and 842 purchasers, granted that they're crossover, that's going to be useful too. So there's a lot more information out there. And also interstate buyers. And before it used to be very local, people wanted to stay local to their area where they were comfortable, whereas people, because they have that access to information, are happy to move and look at different states and different markets that perhaps they weren't before very familiar with. And WA is probably a really good example of that.
Yeah, no, and what you mentioned, this has been one of the biggest flaws in Australian real estate commercial history. Like you cannot get the data. Like you know what the definition of a super prime yield is? Generally, it's about a 5,000 square metre shed with a greater than 5-year WALE. Who's buying that? Basically super fund backed investors who are parking cash up. So naturally they accept yields much lower than you or I would. And they have to kind of deploy that money because they've got the next truckload of it coming next month from the super fund, you know, instos. And yeah, the yields just get tighter and, you know, they buy and sell off each other. So it's a totally different market. It's not really playing by the same rules as the work that Vanessa looks at a lot, which is why I think her data is a lot more relevant to the masses.
Well, it's funny, like when they're selling to each other, all you have to do is look at that retail shopping centre transaction information. Yeah. Well, there's not much transaction information because transferring the properties around their own. They're keeping yields. So they've been
off-book values.
sub 5% forever. And it's not because of the changing market conditions. It's because all they're doing is they're swapping their assets around, keeping all their book values in line, which is probably not a favourable comment to make. But it's true. That's what we're seeing in the market.
It sounds like the whole sector is structurally compromised to some degree, and whether it's the right sort of frame of reference, you've got the sort of the top end of town and you're talking about the insto side of things, and that's just one big game of deploying people's superannuation dollars to make sure they can get a return which satisfies the needs of everyone's sort of retailer industry super fund. What we're talking about is individual or probably small syndicate investors who are sort of sub $10 million. The point for you, Scott, and I'd like some clarity on this, is that if there isn't that many really good deals out there, is that a structural issue, or is it the ability to look inside of the deal to work out how you can make a less so good deal into a better deal? Are some commercial properties always going to be dud commercial properties that never want to be touched, or can you always do something to actually manufacture some positive outcome through it?
Look, it's a great question. Vanessa mentioned one option, like you buy vacant. The unfortunate part of that right now is the owner, like there's some markets, you'd know this, like where the owner occupiers can pay up to 20% more for a vacant shed because they're so desperate, because they don't, like they're a little bit scared off by the rent increases they've had, and there's still significant rental increases per annum. And so there's that option if you can get a good deal vacant, like it might be a distressed sale from an investor. But look, we don't generally compromise. Like we'd rather wait. Like I always say to a lot of our clients, like we could set our mandate at 5% net yields like many other companies. If I did that, I would open up thousands of opportunities for our clients and we'd clean our books out. We'd make a lot more money. All I need to do is talk to you on this podcast and say 5% is good relative to resi. It makes sense. And we'd sell a lot more clients. But you know, we want to hold that minimum yield. Like we might go just under because it's under rented, or maybe it's a really strong area. You know, like we're literally costing ourselves money by maintaining a certain level of quality. But you know me, I'm all about the long-term picture, and I want to maintain a good quality product that stands the test of time. So we're in a higher interest rate. The days of the 2% and 3% interest rates are done. Like we're not going to see that for a long time. So you've got to be factoring in higher interest rates and what yields make sense. And yeah, the clients wait. And there's sometimes complaints, I've been waiting too long. And it's generally in that sub $2 million price point, because that's where the fastest growth of buyers are. And it always will be that. So if you come into commercial, you've got to expect to wait. If you want to compromise on paying a little bit more or go a little riskier, yeah, sure, you'll get a deal quicker. But look, the market's not skyrocketing in price. Like we're in this weird period before interest rates drop. So things like you've got a bit of time. And if interest rates drop, like there's two theories. It'll go through its roof. Like it might go up 20% that day because every vendor goes, oh, I can get more money. Or maybe there's a reason that's scaring people and they need to drop rates where the economy seems a bit risky. And then that will hold some buyers back because there's never going to be the perfect time to buy, you know, that'll slow the market up.
It's always the way it is. And just very quickly, Vanessa, while we've got you on the office market, you know, this whole everyone returning to the office and all this sort of stuff, you know, we're recording this in North Sydney. They're putting up commercial properties like you wouldn't believe. And I think there's still huge vacancy rates here in North Sydney, which needs a lot of infill, right, particularly around with the new metro. But anything you're seeing, you know, this hybrid model of like, you know, and I see some people coming out now saying these regional locations within striking distance of capital cities are still really attractive residential markets because you can do 2 days from home and 3 days in the office. Is it really changing that much, or are we beyond the discussion about return to work?
Do you know what? I really don't know what to think of the return to work. I would have thought that we had moved closer to return to work by now. I think for the office market, I think the office market will recover. There's no doubt about it. The office market will recover. I just think that because like we've had vacancies of this, like granted the size of our office markets are bigger than they were 20 years ago, but we've had high vacancies before. I think there's been a structural shift in the way that people operate and how they're not necessarily even the businesses operate. It's the individuals and it's the workforce. It's fortunate. Unemployment still remains low. If we look at the latest data that came up from the ABS, we're at 4.1% unemployment, which has just been sitting around that place, but it's not moving. The job ads are low. So we're still in a good employment market. So that has been the thing that has prohibited the people coming back into the office, because we are seeing the staff having the power to say, look, I'm not going to come in or I'm going to do things. What we will see, because it will come back, It will come back. I think that there's going to be a massive issue in terms of training. I could talk about this forever. The issue of training, I think people that haven't been coming into the office, there is going to be a really missed opportunity in terms of just their skill levels. I think being able to manage people. I think that there's going to be a whole cohort that are going to be left behind because we're seeing a lot of young people that have been studying, maybe they had to do uni at home, that want to come in the office and have that interaction, and they're going to overtake these people that just haven't been wanting to come into the office.
It's funny you say that, and I want to draw down into it a little bit. We'll just go to a quick break. Stay with us. We'll be back in a moment.
Are you finding this podcast enjoyable but looking to enhance your commercial education? Well, we've created an innovative online course that offers comprehensive content. With over 50 lessons available on demand, you can delve deeper into the subject matter. Additionally, you will gain exclusive access to the valuable online community where you can connect with industry experts. For more information, please visit rethinkcommercialeducation.com.au.
Welcome back. Phil Tarrant, co-host of Inside Commercial Property with Scott O'Neill. Special guest in the studio, Vanessa Rader from Ray White, Head of Research there. Yeah, I tend to agree before the break, your discussion around this, and no one's yet sort of coined a phrase for it, but it'll be like the forgotten workforce or something or other in time. When you fast forward 10 years, they're going to go, there's this cohort of people who missed a foundational formative period of their life, which was university through COVID, and then missed the opportunity to return to work because structurally people weren't doing it. And all those people who were early to mid-career who got used to the idea of work from home and never really re-engaged and connected and never really fulfilled the promise as a workforce. You spoke about unemployment data of 4.1%. I think that the read is that will come down into the threes over time. And I think the government job growth has probably been fueling most of the job growth in Australia. So if you get a change of government, maybe that will change when you go from this idea of big government to a more lean and smaller government.
And what would happen to the Canberra office
and
market
what would
if that
happen
happened?
and what would happen to Canberra office if that happened? But this is a story of the Australian economy is where and how people choose to work. So getting them back in the office, I think, is clear. State governments now said back in the office, particularly in New South Wales. No, there's still a huge amount of reluctance, right?
But are they? Look, I think going back to the office market, I think there's going to be a clear divide. I think the office market will recover, but anything that's premium, it has to be high A. That prime end of the market will do fine. Like demand for that high quality stock will remain. People are able to move into those spaces because there's still attractive incentives on offer. Our effective rents don't look as scary as some people might think that they are. But I think that end of the market will do well. Having a really high quality CBD office presence is something that a lot of businesses need to have. Maybe the space will be smaller, but that end of the market will be doing well. What I'm concerned about is anything that's B or below. So in some markets, look at Parramatta, for example. We're here in Sydney. I think the B grade office vacancy is like 40%. Let's think about what that number looks like. How are you ever going to recover in that market?
How
Who's
bad
going to take up
is
that
B
space?
though? Like I was out in Parramatta the other day in the new building just opposite where they're building the powerhouse, which is I can't remember the name of it. It's a really nice place. But I remember looking out over the Parramatta, and there's still a lot of pretty scabby office buildings that call it that.
Yeah.
Like they're B's and C's, I would imagine, but that's the majority of Parramatta.
Yeah, so so this is the problem. So who's going to take up that space?
Yeah.
Like we will have the return to work start to happen more and more often, particularly with these people that want to get promoted and they want to advance their career and learn something by just incidental discussions around the office. But all that, I don't know what's going to happen to it. Do you bowl it over and start again? Like that's not a popular decision, a popular choice. However, you can't retrofit this stuff into something else. No matter what everyone says. In Parramatta though, if it's an older style building, maybe with some natural light and high kind of ceiling heights, perhaps a resi hotel type could possibly happen. Very expensive. So what's going to happen to our cities, our Parramatta, our North Sydney here and in Sydney? There's a lot of old stuff there. We're going to get into a situation where vacancy for that premium and A grade is going to get down to next to nothing because that's where the demand is. Vacancy for secondary is going to remain really high.
Yeah.
And I think that the gap between those two quality of assets is going to be too wide. Also, you're forgetting the whole ESG piece, which if you're a large firm, you need to tick a lot of boxes. If you're a government firm, you need to tick boxes in terms of sustainability and what your business stands for, if that's important to you. So we're going to see more and more demand in that end of town. Vacancies will get, which we've already started to see. But I have concern for what's going to happen to that older stock in the market and what do we do with it.
Yeah. It sounds like it could be an opportunity for infill, medium density resi, right? Like that's how you actually get that's how you fix a lot of the housing crisis around it. You make more properties available. There might not be, quarter acre blocks out in the burbs, but if no one wants the commercial assets, it should knock it down and turn into
it's just an expensive exercise. I totally agree with you.
Yeah, it's really expensive exercise, but it still comes back to the point of even if you have that as a really good logical development on those blocks, it's impossible largely to get anything developed through councils these days. It's such a roadblock. And talking about Parramatta, I heard grand plans for, the Roxy, the old old cinema out there. Like they were going to build a really
that's been
nice.
boarded up forever.
Yeah, like they're going to build a big tower on top of it, keep it sort of there was going to be an event centre, all that sort of stuff. Just gets blocked. I can't do that. There's too much red tape and bureaucracy, and I think that's what they're trying to solve.
But that's why they keep building, to why are they building? And I notice it all the time. Why is there another building here? It's because as a business owner, imagine going into one of those red brick, no light, old, offices. It's just not an option. It's like a total dud. But you go into a brand new one, you're going to pay 2 to 3 times the rent value, but it just makes total sense because it has that livability and, a premium quality a business wants to mirror their brand off type of thing.
And they're efficient floor space too. So perhaps you are actually taking less space.
Yeah.
But you're able to do that because it's more flexible in its design, or we just don't have this weird columns in the middle, or little corridor to get to somewhere. Which
there's some pretty pokey places.
There is a lot of pokey places, and if you want to, we're talking about unemployment being low and possibly going lower, if you need to attract good staff and good talent, and you want them to come into the office. They've got choice and they're more likely to pick that kind of nicer, prettier office space. Because if you're probably a great business that is in that space, do you know what I mean? So it's a really hard one. Look, I would have thought we were further down the road. I think that the education thing is going to become more and more of an issue. So if we do get vacancy start to come down in that premium grade stock, people will have to go to B grade. Or maybe we'll just start seeing more office development, which is kind of interesting to think. You wouldn't have thought that. Just that high quality office development in the near future. Do
you have a view on interest rates?
Yeah. Oh, look, I think that as much as you hoped that it was going to happen this year, it's not going to happen this year. That will go down next year. We need to see, great to see that monthly inflation data back last month. But look, no decisions will be made until you really see that quarterly number. And I feel pretty confident we probably will be within that 2 to 3% band, albeit quite at the top. Look, a couple of interest rate reductions next year would be my expectation. Probably not until maybe May, though. So I think that's
music to my ears.
I think that's what a lot of people are factoring.
You're the only bloke that doesn't want interest rates to come down. You got a lot of debt, don't you? Want to pay less on your mortgages, mate?
Yeah, but most of it's commercial, so it's still positively geared. But yeah, look, if interest rates drop now because of that whole supply demand equation, it'd be a basket case for a while. Like all those deals we're trying to get at 6 would all of a sudden be 5%. It's just giving us a bigger window.
So it's a good time to buy then.
Yeah, look, it's better to buy now than after the interest rate rise. And I think the main thing is the vendors will ask for more. Because I've been through a few cycles, and the minute there's an opportunity for a vendor in a tight market to ask for more money, they'll do it that day. No other reason. They'll just go, there's more people that'll pay more for it. You could be midway through a deal and then they'll rip the carpet from under you. So that'll be the determiner on price.
Also, I think that just back to that owner-occupier comment, which I think that we could probably have a whole discussion on just that owner-occupier market. Just having the ability, the interest rates are lower, that means they can just pay that little bit more. And they've been quite aggressive in the marketplace now just because they want to shelter themselves from that possible rental changes, whatever asset class it is. Yep. So self-managed super funds, I think that they will be even more aggressive if we do see that interest rate reduction.
Yeah, I'm seeing in Perth, there's owner-occupiers going out to buy tenanted stock because they're always paying that premium. And then they're trying to pay out the tenant to break their lease after purchase.
Really?
And, we're midway through
because they can't get the stock themselves empty?
Because it's cost more, up to 20% more for a vacant shed. So if there's a tenant in place.
How crazy does that sound? Just think that through for a
minute. I know. Well, there's a million people over the years that says, it's a value add opportunity, buy vacant and you're going to get a good deal. Not right now.
Yeah, well, definitely not for premium. Industrial.
No. Yeah, you can do that for office, of course. You'll get a great deal, but then you've got to find the tenant, and that's the harder bit.
Or you bowl it over and do it a resi.
Yeah, exactly. And Brisbane's not that different as well. So, yeah, it's a good time to get in because it's kind of backed by the owner-occupier market. Yeah. So it's not all markets, but, there's markets within markets as well.
I guess the owner-occupier market, if they're looking to transact on commercial real estate, it gives a sense to their attitudes towards the vibrant economy that we live in right now, even though it's sort of a bit subdued at the GDP level. They're looking to back and invest, which is not a bad sign.
I think confidence is the word there. Yeah. I think whenever you see those kind of investors into the market, it really speaks to the sentiment that's in the market and the confidence, the long-term confidence for the commercial property market.
So what is it with property data in commercial? And to Scott's point, it's pretty opaque. Like all the energy and effort goes into the insto stuff, and essentially that's to justify, if you want to be a cynic, justify investment decision making on behalf of the superannuation dollars that people are contributing to. They need to make sure, feel as though that their super fund is putting their money in the right spot, so it gets a lot of attention. Yeah, it's like completely underlooked at.
Yeah. What does it come down to? That example I used before, is it easier to analyse 2 sales or easier to analyse 842 sales? So that's what it comes down to. And a lot of the data that's out there, look, if there was an easy way to do it, it would be out there. And the CoreLogics of the world or the domains of the world would have all this great information that they could give you, but they can't do it. There is a lot of issues with the data, the way that the data is collected, the classification of the data. So zoning for an industrial, for example, it could be a retail showroom, could be industrial. It's an industrial zone land, but it's used as a retail or it's used as a medical centre. Or so the zoning doesn't necessarily indicate what sort of asset it is, and that's what the roadblock is. And every state is different. So it's not easy for you to say, okay, let's just pull out all of the industrial sales in Brisbane, and also then the geography is different again. You can't do that easily because half the stuff you pull out will be a childcare centre or a squash court and a showroom and a... Look, I've been doing this for a long time. It's such a manual process to do this kind of small end of the market. That's why people don't do it.
That's probably why people use buyer's agents, I imagine. So it gives you a competitive position. But I think people still get really confused around, in this space, buyer's agents and seller's agents in the commercial property space.
Oh, exactly. But they're very different. But to Vanessa's point, like it's so manual because we want to use data as well to help justify our moves. And, we had someone going, oh, what's the growth of Townsville the other day? So like we've done in the past to get long-term growth rates, the way we did it, and I'm keen to hear how you do it, was you basically go and find square metre rates of similar sized buildings, similar quality, and you've got to get as many data points as you can. So if it's got to be 1,000 square metre shed, relatively similar condition, see what it sold for in 1990, what's it selling for now, and bring it back to the square metre rate, not the yield, not like its square metre rate was the easiest way we could do it. And the growth rates have been fantastic. We saw, in that case, in 10 years, it was about 9%.
But the thing with that is you needed to know the size of the building.
Exactly, yeah.
But in Queensland, you can get that information. You can't get that information anywhere else.
So how do you get your data? There'd be 1,000 people wanting to know that.
Yeah, it's a super manual process. Yeah. You're pulling data from listing information. You're pulling data from all different places.
So CoreLogic and stuff like that?
CoreLogic is not very helpful.
But it's obviously not.
There's not much info.
There's not enough money in it.
There's not enough money in it to provide it.
No.
It's such a small market, right? It's...
So you're going through manual sales through the real estate agents?
I'm going through line by line sales. I'm going through listings to understand that. I do a block of unit report because obviously block of units been a market. Now, how else do you get that information other than literally trawling through listing information and understanding how many units it is, what is the income for it, what site, what is the makeup of those blocks of units and what this transaction. And this is a market that's tiny in comparison. So no one else does it. But if you sit there long enough and you go through it, and I sometimes recruit my children to do it, especially during COVID, we'll all sit at home doing data. It's pretty sad.
Is this an enjoyable part of your job?
Look, you know what? I really like it. But the thing is I know, I've been doing it for a long time. So I know if it's an industrial property on this street, it's an industrial property. If it's an industrial, if it says it's industrial, I know it's not industrial. It's like a retail or something like that. So if you have to actually go through and there's a lot of stuff that I just useless information that I just know.
You're like the oracle of
in locations as well. If I know it's in this place, well, I know it's not really an industrial. They say it is, but it's not really. Yeah. So unfortunately, it's a very manual process. If it wasn't, everyone would have done it.
Yeah. So you've got a lot of knowledge in this information that you have. If you're going to invest in property today, where would you invest?
Oh,
commercial?
I hate that question.
I know.
Do you know how many people ask that?
But you probably know more than most,
I know the answer for her.
Yeah, it's definitely a retail.
Yeah.
Is that what you think I'm going to say?
And then secondary industrial is up there.
Well, why not? Why not? There's
secondary industrial?
Well, non-prime.
Non-prime.
Okay. Yeah, the level under where all the mums and dads are building up because they all want industrial.
Well, the industrial stuff just makes sense because of the lack of zoned industrial land, be it developed or not, and that data is available. You can find out how much zoned industrial land there is in every city and how much of it is developed. So there's not very much. There's not much left over. So if it's on a good location, that could eventually be turned into something else, they're like, you're winning with that. Retail has been like the underplayed asset class for the last little while. I feel pretty confident on retail. I think retail will be a place that will come up, like improve. I think neighbourhood centre, if you've got enough money, a neighbourhood centre. If you've got even more money, a sub-regional centre, because everyone likes shopping at Kmart. Like a Kmart Big W type place in there is quite a lucrative tenant to have. As long as it's like a good mix of a supermarket, specialty food and services, you don't need to have like a random sports girl or Suzanne's in there. That does no good.
Suzanne's,
I don't even exist anymore.
It does.
But like you need to have services. So someone to get your nails done, somewhere to get your hair cut, beauty services, injectables or random stuff like that. That's what's doing well. Those sort of tenants are looking for spaces in like neighbourhood locations.
Regional neighbourhood or just metro neighbourhood?
More metro. Like I know you mentioned regional before, but again, have me on for a whole regional discussion. But like drive in, park easily and walk into the store. They're the sort of centres that are going to be doing well.
What do you got to spend to get into that sort of stuff? Like
probably a bit more, but
$5 million up.
You need more than
well, that's for your neighbourhood shopping centres.
Metropolitan neighbourhood.
Look, I saw the Kmarts of the world start around 10. Like that might be a kind of a Launceston job type thing. But to your point, the big difference between that and industrial is they are building a lot of industrial. Like there's still a shortage of it. Like I think we're 3.8 square metres per person. If you look at Singapore, it's 8.8. So like we're way undersupplied. Like
industrial.
Industrial. But they're not building shopping centres.
No.
And there's going to be some lag growth because industrial's gone like that relative to it. It's pretty cheap now as a retail investment. That's kind of why I've been heavy personally in retail. Like everyone was going crazy for industrial. I just like the longevity of a good shopping centre. Like it's going to be there in 50 years or it'll get rezoned and be something even better. It's good land. Also,
that's the other thing. You think of these shopping centres, they're on either major road locations, like main road locations, close to a train station or a bus probably stops right at the door, has a probably little bus shelter there just for that shopping centre. So down the track, there's a good opportunity there for that to be, some sort of residential development, put the shopping centre back in. But I think that there's huge potential in those sort of assets. And to your point, and I wrote a piece on this probably a month or two ago, that we have not built retail. Our population has grown. We have not built new retail. So the retail per capita space has become less and less and less and less. Granted, everyone's worried about online retail trade. Our online retail trade has been static for the last little while. So we are buying all our Suzanne offerings online, but we're definitely not buying as much.
I saw a stat the other day, and I'm probably going to get this wrong, and they're trying to police it, like 50% of all online fashion purchases are returned.
Really?
Yeah.
Wow.
Yeah. So essentially what happens is
that just means you need more industrial, and you need more industrial in infill locations.
Yeah.
That's that last mile piece.
Yeah.
And maybe I'm just going to put this out there because I'm not sure if we're close to the end. I'll just kind of drop this bomb.
Yeah.
What about some of our secondary office spaces? Can we turn those into some sort of mini last mile distribution type drop off your returning goods or something? I don't know, is there potential for reuse into that or even self-storage type facilities?
Self-storage makes sense.
I'm a big fan of those kind of secondary offices, freehold ones, not in the CBD because access is too hard. But like if you're like 10 Ks out, like the Alexandras of the world or South Brisbane, like, a big freehold office, you're right, it could be, they're making 2-story warehouses these days. So it could be anything down the track. But there's a lot of big businesses like logistics or in that kind of industry that really need those office spaces too. And they don't want to be in the city, and per square metre, it's a lot cheaper. And that's the key. Like instead of paying $600-700 a square metre rent, that might be $300, half price. So plus you get car parks. And
car park is good, half price is good, but we've gone on a lot there. That's good discussion, but we're not going to solve all these problems today. We need to be about. But it's time for our burning listener questions, Scott. There's a lot of burning questions, so let's just get through a couple of them really quickly. Okay, so first burning question, Vanessa, I'm going to get you to answer this. For a deposit, maybe in the data that you guys pull out of it, the proportion of buyers using property equity, i.e. borrowing 105% versus unencumbered cash. Are most people equity investors or they got cash money?
Believe it or not, there's a lot of cash out there.
Yeah.
Yeah, you saying that. I'm always surprised at the volume of liquid buyers that are out there.
Yeah, I read somewhere that was the fastest growing portion of buyers, like cash buyers. And they're specifically in that sub $5 million price point, but I don't know where they're coming from. Like they've just got cash. Like a lot of the people that go to those auctions, those famous commercial auctions buying a Hungry Jack's at a 3-4% yield, cash buyers.
And if you sit there long enough, you see they miss one and they just kind of go to the next one.
Yeah.
Well, that kind of time has passed a little bit now. But yeah, certainly a lot of cash buyers out there, which adds to that issue of why would you sell? Where am I going to put that cash if interest rates do go down?
Yeah.
And cash buyers also, is that depending where you are on your investment journey, putting all your dough into one asset in cash might not be necessarily the right thing to do, right?
No, definitely not. Like no matter what, you should follow a model similar to what a fund manager would. Like try and leverage 40, 50%. You got twice the assets, twice the tenants, twice the diversity. I don't see any logic in not using finance. Like I don't look at like a loan as the amount you owe. Like let's say you owe, have $100 million of debt. I wouldn't look at it as $100 million. I'd look at it as the amount of repayments you're responsible for. If your cash flow is $10,000 a month and you've got a $3,000 a month obligation and it's spread over many tenants, that's an easy debt to cover, especially at the current interest rates, because that $3,000 might turn to $2,000 or whatever. So that debt is actually going to amplify your returns over a long period of time, which will be a hedge against inflation, and you'll have the diversity in the larger asset base, which, long story short, will make you more money, period.
Well, it's spreading your risk.
Yeah.
And commercial real estate debt, easy to obtain at the moment versus resi?
I think it is. Yeah, you still got to go off like your 65%, your interest rate covers, different loan terms, but generally the banks are quite aggressive at the moment. They're getting better. The interest rates are coming down. Like I'm not going to quote rates because everyone goes, oh, why am I not going to get that rate? But every person has a different situation and the banks will lend according to your risk. So if you can get a loan, just be wary of how much it is. And I don't think you need to factor in interest rates to increase by 3%, but the banks have their interest rate buffers in place already. So if they're willing to lend you, they're quite responsible for this as well. So take the loan.
And it's a really important indicator on the quality of the asset you're buying is whether or not a lender is willing to stump up the dough around it.
Yeah.
And whether or not they're happy to do that in other similar properties in similar regions, right? It's when they have postcode restrictions and they don't lend in particular areas. It's a pretty clear indicator. It's probably not a great asset to be buying.
Yeah, exactly. Like I had a conversation with a New Zealand bank first time. And they literally just went, oh, look, you're probably going to get a 65% loan, but if it's a childcare, 50 to 60. If it's secondary and risky, it's probably more of a 50%. And they basically said, just come to me when you got the property, because that determines the loan. I'm doing a standalone deal because there's no way I want to have to go through the entire position I've got in Australia. So standalone deal, 65%, 50 to 65. And they're a lot tougher than Australians because there's less competition with the banks. So yeah, Australia's even easier than that.
Well, it depends on their book as well. Maybe if they're overexposed in childcare, that's why they want to see that. So
you never know until you actually make a inquiry.
100%.
Yeah. Other question here, Scott. $250K deposit for the first property. Would you jump straight into commercial?
Good question. Line ball. I would say it really depends on the situation, what job you've got. I've been pushing more people towards splitting that between two resis at the moment. If they've got the cash flow, they're working for a while, they're not retiring in 5 years' time. Like you're going to probably do better with leveraging a higher amount and buying two resis because residential, it's going pretty well, especially if you pick the right market. You're going to have a good few years ahead. Commercial, you're going to be more in a waiting list situation or take more risk. Like Vanessa said, there's always deals out there. You can buy one for $100,000, but it'll be a storage unit in the outskirts of Melbourne and they're building another 10,000 of them and the bank won't lend to you. So cheap is not always better, and that's where residential will win. But as that price gets bigger, the case for commercial becomes larger and larger. If you've got, $500 million as a deposit, like it's commercial all day. And hopefully you've got a few residentials behind you as well. So you've got that diversity play. Because I'm not all for one. I don't know many people that have 100% commercial portfolio, but those who have 100% residential portfolios are missing a great opportunity for cash flow.
So on that basis, if you had $1 million in cash and you want to deploy to your point to commercial, what would you be buying today?
I'd probably do one deal. Yeah. So you'd leverage that up by about a $2.5 million asset. That's a good quality one. You could even buy two well-placed strata, industrials or one retail, one industrial. I'm quite open to regional areas because your 2.5 mil will get you a much bigger property and bigger is better with commercial because the business is more stable. They've been around for longer lease potentially, harder for them to move. So yeah, look, 2.5 that's about our average price, by the way, at Rethink. So we do a lot much higher and a lot cheaper. But the deals are good. And there are not many of them still. So you still got to wait and pick the right deal. But they're generally an asset, like Vanessa said, that you would never sell. Like it's for the next generation. So if you're lucky enough to have $1 million cash, you're buying it for your kids. And that's the way to look at it, and hold it forever, pay it halfway down, always keep a bit of debt. I think it's silly to have a completely debt-free property because, like we said, you can buy 2 of them and you should do pretty well. Yeah,
and you should be able to hold that positively geared and put money in your back pocket. Nice one. Well, good to see you again, Vanessa. It's always nice catching up as an informed and regular commentator, it would appear, with Rethink and on this particular podcast. So keep up the good work. You probably don't share all that data, do you? Hold it pretty close to your chest. So
no, don't ask me for those listed.
Don't ask for this. You can't do it. All the hard work goes into it. So Vanessa Rader, Head of Research, Ray White. And Scott, good to see you, mate. Gearing up for Chrissy. You've probably got a big backlog of people waiting for properties, but you're always happy to chat with new clients and customers.
Yeah, no, crazy time of year. Lots of travel, heading to New Zealand again, trying to get down to Melbourne, up to Queensland. Like, it's all happening. This time of year is like the grand final season for property because it's spring. Volumes are a little bit better. But yeah, there's a mad rush till Christmas generally. And then January it's quiet. And everyone the whole industry just falls asleep till February.
Holiday, are you?
I'll try.
Try?
Yeah.
Maybe?
Yeah.
Yeah, cool. All right, well, thanks for tuning in, everyone. Inside Commercial Properties, episode 54. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.